Morning, everyone. My name is Jason. I'm a board member of the CFA Society of Detroit. Thank you all for attending today's presentation. A couple of housekeeping matters first. You will have received a confirmation email this morning, and in that email is a link to the speaker's presentation slides. Those slides are also available on our website under the Past Events tab. So you might want to download those. We've got some events coming up, including our annual meeting and golf outing. The annual meeting and golf outing is going to be held on Tuesday, May 30th at the Oakland Hills Golf Club. It is a very popular event, so you want to book some tickets pretty fast for that. If you don't play golf, come anyway, because there's still the meeting and there's food and drinks. I went last year. I don't play golf, but I still enjoyed talking to people prior to the golf event. But the golf itself is fabulous. And please make sure you renew your CFA Society and CFA Institute membership. That's coming up. Watch out for an email from the CFA Institute. I've seen the email. Dues from the CFA Institute are going up to $299. Someone decided that we're selling dues like we're selling cereal or something, and we wouldn't be tricked by paying $300. So watch out for that. I'm going to turn it over to Blaze Gripper from Accords and Investments to introduce our speaker.
Great. Thank you, Jason. Appreciate the introduction. I want to thank all the members of the CFA Society of Detroit that are taking times out of their busy day to join our discussion today. And also a big thank you to Michelle Duran for organizing today's webinar. And also Ashley DeSteiger of Gunder Wealth Management and Chris Ruth of Key Private Bank for introducing us to the CFA Society here in Detroit to present on this meaningful market update about private real estate, values, liquidity, and fundamentals. Again, my name is Blaze Grippa, Executive Director of Accord Investments, or what was formerly called USAA Real Estate Private Wealth. Today, we are very happy to introduce two people, Garrett Zadolchek and Brian Thomas of IDR Investment Management. Garrett is the Chief Investment Officer and also a partner at IDR, and Brian is also a partner at IDR and the head of analytics. He's also an active member of in NCREIF. IDR is a sister company to Accord Investments, or again, what was formerly called USAA Real Estate Private Wealth. Their company is based in Cleveland, Ohio, and manages close to $6 billion in core real estate assets. Also, they developed the first and only private real estate index fund that closely tracks the performance of the NCREIF Odyssey Index, or the private core real estate market. The index today is over 40 years old, represents just over $300 billion of core private real estate. So IDR offers a unique ability to address this topic on the market because they are direct investors into the NCREIF Odyssey Index. With that, allow me to turn the discussion over to Brian and Garrett. Thank you.
Thanks, Blaze. So I will kind of start walking through this, and Brian and I will kind of hopefully make this interactive. We asked Jason, feel free to ask questions as we go. This is your time, so want to be as helpful as we can in kind of describing the market and the views. So without further ado, maybe I'll jump into the agenda here today. We'll start with maybe explaining a little bit about what this index is. I think everyone knows what the S&P 500 is or the Barclays, but obviously private markets have a little less transparency. We're hoping to fix some of that, but the Odyssey Index is a primary private markets, private real estate markets index, especially for the pensions. For example, State of Michigan Pension Fund, up by you all, is a client, that indexes a portion of their real estate holdings with us in this index. And I'll explain more about that. We'll talk a little bit about how private real estate can help diversify a portfolio. And we believe, private real estate is really kind of the third leg of the asset allocation stool between stocks and bonds. And then finally, I think, everyone kind of thinking about values today, recession, aren't we in a recession, rising rates, when will they stop? What's that mean for real estate? So we'll delve into kind of current current performance, along with kind of our, bit of an outlook of what we think, is to come for the rest of the year. So with that, maybe I'll jump right into it. I mentioned we really believe private real estate, has a place in the asset allocation world. If you think about it, equities, higher return, less current income, fixed income, certainly lower return, supposed to be more stable, notwithstanding the last 12 months. But real estate really has the attributes that kind of transcends both sectors. There's some pretty good current income. Cash flows from rents go to pay that income every quarter. And then on the other side, though, there is a equity tilt in that investing in core real estate, does give you the potential for appreciation, and have the value grow as income increases, unlike a bond where you get a fixed rate at the end, hopefully. As I mentioned, the Odyssey Index itself, and we'll talk about what's in it in a moment, but the index, when we talk about Odyssey, has about $350 billion of real estate assets, diversified across the U.S. And diversified by property types. And as we look at it and see through the funds, there's over 4,000 institutional investors in these funds that own that $340 billion of real estate. We're obviously one of them, and our clients are, but many more. Obviously, it's a large, diverse investor base, kind of similar to, as you would think, to a REIT index or something where a lot of investors own various REIT stocks. The difference really is it's private versus public. The managers of the funds that make up the index, are some of the largest, probably most well-known investment management firms in the world. Starting at the top, people like JP Morgan, Morgan Stanley, PGIM, UBS, and the list obviously goes on. Some really high quality firms and managers run these funds for the investors who own the assets. So it's a very clear line of quality, and typically these funds are the flagship vehicles of these firms. Brian, maybe I'll let you take the next slide and kind of explain a little more about what is in Odyssey and how it's made.
Thanks, Garrett. So Odyssey Index today, let's start with leverage on the top right-hand corner, 23%. So this is the opposite of your house when you buy a house. It's not 80% levered or something like that. It's not a high risk return strategy. The Odyssey Index is essentially low levered, low risk core real estate benchmark. So that's kind of the most important attribute of Odyssey. The next thing is, Garrett touched on, it's diversified across 26 funds. So there's many managers, just how you expect in a REIT index or bond index, something like that. And then high occupancy. You read all kinds of stories when you pick up the Wall Street Journal about what's going on in real estate. The Wall Street Journal loves to write about what's going wrong out there, right? Defaults and all these things. The Odyssey Index is very, very stable. It's 93% occupied, again, low leverage. So there's just not a lot of risk in what you're seeing in this index. And then diversified across 3,500 properties. Switching to geography on the bottom right-hand corner, you can diversified heavily around this smile around the United States. So from Seattle down to California, across through the Sun Belt, Texas and Florida, and then all the way up the East Coast to major Northeast hubs in Boston and New York, et cetera. So major market focus would be the bottom line. And then on the
Brian,
side,
Brian, that's largely right, because that's where the growth is in our country, right? Unfortunately, we're from Cleveland, by the way. We're in the Midwest as well. But these are the areas population is going to, and where there's growth and a need for the assets, right?
Absolutely. The real estate is all about population growth, and where the people are, there's a demand for real estate. So that's why you're seeing heavy weighting to California, Texas, Florida, those types of states now. And then from the property type, which is, Jason, do you have a question?
Yeah, so I need to understand the leverage a bit more. So the 23% leverage, is that the debt that is used to buy the assets, or is that the debt that's in the funds that are used to buy the assets?
That is the debt that's in the core real estate funds that buy the assets. So essentially, core real estate funds will buy properties unlevered and just put them in their portfolio. And then the most efficient way to leverage is at the fund level. So they'll issue private notes. There's also debt at the individual asset level as well, but the most efficient way is at the fund level. So
okay, right. So if we were to compare the leverage versus, say, a real estate investment trust, the real estate investment, like, is there the potential for the true leverage to be higher than the 23%? Because the funds have borrowed at 23%, but some of the properties also have leverage in those assets.
So it's an all-inclusive number. It's called a tier 1 leverage ratio. Yeah. So it's similar to where the REITs are they're levered today, probably a little over 30% or so.
Okay.
Going back in time during the GFC, it's 35, 40%, but they are very comparable statistics when you look at public REITs and the Odyssey Index.
REITs do tend to be have higher leverage than this market. But this is, Jason, to your point, this is a complete leverage profile, whether it's at the asset level or the fund level. This is all in leverage. And again, it's meant to be very low for that stability.
Okay. And I'll mention, just while we're talking, other participants, just raise questions in the Q&A part of the webinar, and I will funnel them to our speakers.
And Brian, then the growth too is projected in these property type exposures as well, right?
Right. So it's not a static index. It's actually moving over time. And so what you're getting with the entire Odyssey Index is the collective active management of those 26 real estate funds. And so the index moves over time, and we have a slide that will show that. Right now, the two best performing market sectors are industrial and apartment. That comprises about 60% of the Odyssey Index. Office and retail have been shrinking of late, so they're down to about 30% total of the index. And then the other component is mostly self-storage. There's some life science, student housing, things like that.
So performance, Brian, I think performance has been pretty strong. Obviously, I think real estate is viewed as an inflation hedge because, if rates are going up, generally you can push rents. It's a growing economy. It can come with a cost to the capital markets, which we've certainly seen in the public markets of late, right, with rising rates. But overall, performance, if you think about these numbers, especially over the last year or 3 years compared to, stock and bond portfolios, they've been really quite strong, I think. And so, they've been a good diversifier. We'll talk more about that going forward, but they have been a good diversifier in the fund or in a portfolio. I do see we do have a question about, are there hotels in the index? So going back to the other, if you look back in history, there were hotels in the fund or in the index years ago. I think there's only 2 or 3 left at this point, literally 2 or 3 assets left. One of the things I think that core real estate managers have learned is that hotels are not necessarily as stable always as some of these other assets with longer term leases. So, other can be great. There's a lot of talk about these alternative sectors, but they also come with some risk and less proven ability to maintain strong current cash flows. So not a bad thing, but maybe not always core. And that's why really the managers have sold the most of the hotel ownership over the years. It was only as high as 2 or 3% to begin with, but it's virtually non-existent today. And as Brian said, this 8% is largely self-storage and life science. Are these cash on cash returns or returns based on equity value? So both. This is total return. Of that 6.5% over the last year, close to 4% of that was, I think it was current income, Brian. Does that correct? So again, I think real estate has both components, of that stock and bond profile. About 4% of that return was current income, and about 2.5% was value increase, in other words, over the past year. So Brian, maybe take us through the index evolution and why, pension funds are indexing these or this market today and maybe weren't in the past.
Right. So the bottom line is the Odyssey Index has changed a lot over the years. So on the left-hand side of the screen, you're looking at the year 2000. The Odyssey Index was 22 billion. There were only 11 managers, and the top 5 largest funds comprised 85% of the index. So you could essentially closet index by just investing in a few managers, and you're kind of going to get the core real estate benchmark return. However, that's changed a lot recently. So if you look at 2022, again, 340 billion, 26 managers, the top 5 largest funds only comprise 50% of the market exposure, and that number is continuing to decrease as more funds come into the index. The other important factor is that the property type changes, which is leading to return divergence and other things that we'll cover. But if you look on the right-hand side, you notice the different property types as a percentage of the index was very steady from actually going back about 20 years, but from 2012 to 2018 or so, they were very static. You could manage your portfolio very efficiently to the index by tweaking here and there. But what's happened since with the rise of e-commerce and then what's going on in office today as well, you can see the dramatic shift in property types that the managers have pursued with their strategies. And what that's leading to is a changing index that's very hard to replicate, and it's very, very hard to closet index.
I think we're often asked, transparency in the index is a little harder. You can't see the best performing fund or the worst performing fund. REITs are really like stocks. So we think about kind of performance and volatility in 2 ways. The first, let's start with the fund level. The dark blue line is showing you the difference in any period between the best performing fund and the worst performing fund. So for a market, core real estate, we really expect to do about an 8% return over a full market cycle, about half income, half appreciation. But as we look historically, as you would expect, during times of like the great financial crisis in 08, 09, that volatility increased substantially. And then more recently, but, I think groups are often surprised when you think about real estate. It should be relatively steady and easy, we call it easy 8. But in reality, the funds have a lot of different performance characteristics, and the real estate does too. So, the difference today for any, for picking a fund, it can be upwards of 25%. It was as high as 40% last year. And again, that's, I'm trying to achieve a total 8% return. The volatility can be substantial with real estate. And I think that's often overlooked because the transparency and the views into that, are pretty hard to see. Same can be said of property type, and we'll delve more into performance of sectors even, but the difference, in sector performance can be enormous. And we really haven't seen this big of a difference ever before. The performance of, for example, office and industrial, have really decoupled. And so if you look at, for example, the great financial crisis, the fund performance got really wide, but the sector performance didn't. The volatility was really driven by quality of asset, not sector or type of asset. Whereas in this cycle, the exact opposite has really been true so far, where it's been much more about allocation. Did you own the right sectors? And it hasn't been nearly as important if you own the right quality within those sectors so far. We think that will change going forward. It typically does in the cycle, but we've never seen kind of the divergence so wide. So Brian, maybe you want to talk a little bit more about, the sector performance and what we're seeing in each sector.
Right. So what we're looking back here is 2022 annual returns on the right-hand side. On the left-hand side, or below the negative returns, are all from the fourth quarter. And so the biggest takeaway is rising interest rates have negatively affected private real estate across the board. There's just no way around it. Those rising rates are affecting transaction volumes, the bid-ask spread, and what people are willing to pay for real estate. And that is all filtering into the valuations of private real estate. But as you can see across the different property types, and this emphasizes the importance of diversification and not putting all your eggs in one property type or basket or one fund. You can see there's quite a barbell here. So on the left-hand side, industrial, other, and apartments have fared relatively well compared to their peers in this market cycle. The Odyssey Index overall had positive 2.3% appreciation for the quarter. And then if you're looking on the right-hand side, two stories here. One is retail kind of started revaluing in 2017 through 2020. That's when they took most of their lumps and revalued quite a bit. Retail's probably fairly valued in today's market. Actually pretty healthy fundamentals there when you peel back the onion. And then office, which kind of held up through 2020. Once COVID hit, there's just the changing work from home environment and those types of things have really impacted the actual fundamentals of office. So going forward, office will be a little bit weaker performer relative to the other outperforming property type sectors.
And Brian, and I think maybe we should touch on this a little bit because you kind of mentioned early on, you read things in the Wall Street Journal and things, which are great articles, but they're focused on single assets, right? So yes, there will absolutely be a lot of office going back to the lenders. There will be a lot of challenges there. But those aren't all buildings, right? So for every building that is going back to the lender, it's typically an older asset, something that needs a lot of capital with limited occupancy. There's also newer buildings, that are very well occupied and frankly achieving record rents, that are full of ESG benefits. The companies are really taking a view today. They need to make the workplace nicer than home is what I've heard a number of times from the CEOs, because they need people back in the office, right? They need collaboration and creativity. So, it's a really bifurcated market, even within these sectors, where, the best assets are actually doing better than ever. And frankly, everything after that is challenged. So you'll see it in the numbers overall, but I think it's surprising a little bit. It's not much worse than this because there's largely, in this index, at least, it's largely high quality assets. There are some opportunity funds out there and some higher risk groups that, are giving back assets. And I think we've probably only seen the start of that. There is definitely more to come there as well. And kind of as I mentioned, the volatility within, funds and sectors or between sectors, it also exists within sectors. So over the last year within the index, this is showing you kind of the blue dot is showing you the average sector return. That's weighted average among all the properties. But there's really a wide outcome even within the sectors, right? So if you owned an apartment asset, you could have got an 11% return on the high end, or you could have lost 9%. These averages are averages, right? They're weighted averages. And so everything's not created equal. You're going to see a lot of divergence within sectors as well, which is why we think it's just not enough to just say, hey, I own industrial. Industrial has been great overall, but if you're not diversified, if you don't own a larger portfolio, you can have really wide return outcomes because of that.
And there's another layer to that, in that the asset class you're talking about, that the investor it's very difficult in a private real estate asset class for the investor to have good information about any particular asset, right? So I can get good information about a publicly traded company. I can't have good information about the prospects for an individual apartment building, an individual office building as the individual investor. So if I put all my chips on one apartment building, one office building, I have even less transparency than buying any individual stock. So that makes, I think, the diversification argument even stronger.
Yeah, and look, you know, Jason, to your point, right? If you're trying to get 40% returns, by all means, buy a single building. You need to make a really targeted bet and be really aggressive and opportunistic, right? But if you're trying to get an 8% return and expect to get an experience like this index on a historical basis, you know, you're not going to get it with a single asset, like most likely, right? You're going to have a lot of volatility. It's like buying a single stock when you want the S&P outcome. You know, you're just not going to get it with a single bet. So, you know, and again, it's, you know, pensions around the country, individuals around the country own single assets and, you know, build portfolios. But the transparency to that risk and the volatility you achieve because of it, you know, has been somewhat limited in the private markets to date. So we're hoping to kind of show some of these, you know, analytics because, you know, we really, by being an index manager, you know, we have transparency into, you know, the entire market, if you will, and all 3,600 assets. You know, and same goes, you know, for performance, right? So here's kind of the quarterly, you know, I previously showed you returns broken out on a kind of trailing 1 year and time weighted returns. Here's the quarterly returns. So you can see it's, you know, largely very positive, largely very consistent. Saw a little bit of negative return with COVID in some sectors in the kind of, you know, really starting in 2Q 2020, we saw negative 1% total return. And before that, though, you know, I think it's often overlooked that retail decline really started kind of in the 2019 period. So COVID certainly exacerbated and I think accelerated the retail challenges in this country. But it started long before COVID. You know, kind of fast forward through COVID, you see the huge rebound in performance of really all sectors, but especially industrial. You can see here how much industrial has mattered in performance over the last kind of 2 years coming out of COVID. But what I like to point out are two things. If you go back earlier, you can see office was a huge component of performance and return pre-COVID. And then retail as well was a meaningful component of return. So I think it's important to be diversified. You know, I understand there are headwinds and challenges in office. We have a lot of investors saying I want to be underweight, and I think that's a valid comment. But I think it's also important to remember these assets will cycle. Things come in and out of favor, and just chasing, you know, industrial performance, for example, you know, we're starting to see that come back around as well.
That decline in the retail performance seems to begin like the end of 2015, but like the fascinating part is that it keeps declining, like quarter by quarter. That retail component keeps shrinking and eventually turns negative. So it's almost as if, in terms of the asset prices for retail property, that there's this continual underreaction to how much e-commerce is eroding away the rents that retail property can charge. It's like the asset price is never quite correct enough, and then there's another shock, which means that property values are down again because we keep buying more stuff online. It's like there's no point at which the market says, okay, this is like a perpetual change and the asset prices are going to correct.
You know, I think that's a fair view. The only kind of comment I'll make maybe against that is, you know, these are total returns, and private real estate, you know, like I said, there's a lot of current income coming off of these assets. So even though, to your point, Jason, really kind of after 2015 into 2016, that's really just an income return that you're seeing there. There's no value change, right? And so I think the cash flows of, again, this high quality, you know, there's a huge difference between a high quality mall, for example, frankly, the dominant center in a market, versus that Class C building that, you know, Class C mall that is probably not in existence today. So, you know, again, this is not representative of the whole market, if you will, because there really weren't any Class C malls in this index. You know, it was really high quality again. So none of these malls went back to the lenders. None of these malls went into distress in this index, you know, owned by these managers. There certainly was a lot of that happening in the broader market, you know, which kind of translates back to that office discussion as well about the difference in quality and location, you know, and tenant base. You know, it really matters in the real estate market.
Yeah, so those, I mean, the retail assets in the index didn't become distressed, but the rents must be sticky or going down. So it's like, it's not as if they're going into bankruptcy, but when they release the same premises, they're getting a little bit less each quarter as those tenants release, because there's more available space in other areas.
Yeah, 100%, which is why, you know, those 5 caps in 2015 never went any lower. You know, in industrial, for example, to give you a sense, you know, starting in 2015, I would argue probably industrial and retail caps were pretty similar. The difference is industrial caps went from 5 to 3, you know, and retail didn't change. It's still at a 5 today. So a lot of that return you see on industrial is mark to market, is financial impact, right, of cap rate compression, not, and certainly it's happening because expectations for rents are going up in industrial, you know, versus retail, to your point. But I think that could reverse a bit too in these higher rate environments. Brian, do you want to maybe we switch gears a little bit and talk about you know, the index, if you will, you know, private real estate in an overall portfolio context?
Great. So, you know, why do the largest pension funds in the United States, you know, benchmark to Odyssey? Why do they use it? Why do they invest in it? So what we're looking at here, you know, is the asset class risk return spectrum, with total return on the left-hand side, risk along the bottom. And you can see, you know, the 4 major asset classes here. So Odyssey is towards the upper left-hand positioning. That's always good. That means a little bit higher return than bonds with similar standard deviation to risk. And then you look on the top right, you'll see, you know, stocks and REITs. So what is Odyssey providing in your portfolio? It's kind of halfway between, you know, stocks and bonds. So it's got a little bit higher total return. It's got very consistent income. The way it behaves in your portfolio, it is a little bit less risky, and we can see that over multiple time periods. So on the left-hand side here, you're looking at, you know, 5-year comparison of Odyssey to the different indices, and then on a 15-year basis. You can switch the time periods. It's always going to look somewhat similar. But focus on the 5-year front, you know, the annualized total return of Odyssey, you know, 7.7 compared, you know, again, above REITs, slightly below stocks, above bonds. Look at the 15-year, you know, slightly below REITs, slightly below stocks, but above bonds. So it's kind of always doing kind of in the middle or helping your portfolio in some way. Much lower standard deviation than the other asset classes, and then less correlation as well. So a really important thing we also like to point out is negative quarters, because we know in stock and bond portfolios, you know, depending on the quarter, you're always up or down or something's happening in the public markets. Odyssey, because of the income, the steady income, it tends to really produce a positive quarterly return. And so again, 45 years of historical data here. But you know, it goes up about 90% of the time because of that income. So on the 5-year, we had 2 negative quarters. One just happened and one was because of COVID, which makes sense. And then on the 15-year, only 8, and that includes the GFC. So we had the GFC was several quarters of write-downs, 1 period for COVID, 1 period for rising interest rates. So relatively, how it's going to behave in your portfolio, it tends to produce a positive return over the long term.
And I think a picture speaks 1,000 words, Brian, if you want to talk a little bit about these lines.
Right. So you can see the REITs is the orange line and US stocks is the S&P is the bright green. And you can tell that those move somewhat in tandem. And I think everyone probably on the call understands this, but you know, REITs and S&P, depending on the time period you're looking at least correlated by 0.6. During periods of high volatility, if you look on the right-hand side, which we've just seen in the past cycle, they get extremely correlated up to like 0.8, 0.9. And the reason is because, you know, the public market, the movement of the stock market is just affecting everything. REITs are going to sell off in line with the S&P, whether real estate is frankly doing good or bad. But, you know, did the value of US real estate drop, you know, 30% during COVID? Probably not, but it was a pretty scary time and public markets affected that. What you're seeing in the blue line is that's Odyssey. And so going back through the GFC, you can see the downturn on the left-hand side back in 09 and 2010. Then relatively very consistent performance for about a decade straight. Returns did vary, but on a 1-year trailing basis, very positive long bull run. And then we saw the COVID in the most recent higher interest rate downturn. But if I'm a portfolio manager, what I want to add to my income, my portfolio stream is that steady line that's not moving nearly as much as what's going on in the public markets.
But how much I think we have to look at this chart like for another couple of minutes, because how much of that steadiness is just sticky valuations?
Oh, I think there's some for sure, right? If you look kind of at the most pronounced time frame, I think is the financial crisis, right? So REITs, US stocks declined significantly before private markets, right? And private markets kind of followed. I think, though, the interesting part to me is the public markets were actually recovering as the private markets were bottoming. So again, you get that non-correlation, I think, from a actual impact. The other thing, though, I think it's important if you kind of follow that through a little more. Certainly you could have argued, okay, public markets foretold a decline in value, in the private markets. True, at that time. But there's a lot of false negatives too. Look how many other periods of negative return you kind of see in the public markets reacting to various exogenous events or whatnot. That really doesn't affect the private markets, right? Kind of averages out. So I think, we kind of say the public markets can foreshadow a private markets decline, but they're not very accurate. They have a lot of false negatives.
So let me rephrase my question. So there's two things that could be going on here. It could be that in the public markets, if we look at the red line for the REITs, it could be that there is this systematic overreaction and then an underreaction to shocks to the economy, shocks to interest rates. Like you see at 2008, this big negative and this huge rebound and then back again. Or alternatively, it could be that that just represents true market value. And in the index, we've got an estimate of value because there's not continual transactions. And it's an estimate of value, but it's a bit sticky because there is some underreaction of the person coming up with the valuations of these private assets. So let me rephrase the question. If I'm holding an investment that replicates this index, in terms of the valuations appear in this chart, can I actually redeem my units in that fund at those prices on those dates? Like those
Jason,
transaction prices, yeah.
Yeah, I think that's a great point because, numbers on a page are numbers on a page, right? And so I would tell you, yes, 95% of the time. Okay. So what that means, any day, any second, right, you can go to the public markets and create liquidity and get that value no matter what, right? Which is why I think there are such deep bottoms and tops to these lines, because it could be a forced seller, it could be a forced buyer. There's not an orderly necessarily market every day of the year, right? So absolutely, public markets are more liquid. I would tell you this blue line, 90% of the time you can transact at this number, because that's how the funds are bringing investors in or sending investors out, is based on the value of the blue line. The caveat I'll give you though is, in the GFC kind of leading down, starting in end of 2007 and 2008, you really couldn't get your money out until you hit that bottom. So there are illiquid or challenge periods where you're not going to get complete liquidity, because the value isn't maybe perfect. And that's why, in essence, you probably have, gates. I mean, you read about some of these public market vehicles today, like the private, like the non-traded REITs, and they have more redemption requests than they can fulfill or need to fulfill, because people like the value today, they're concerned about the value tomorrow, so they want their money back, right? That's really just saying the bid-ask spread is off. Mm-hmm. And so until values adjust a little more, I actually believe, and we kind of planned to end up touching on this, but I actually believe a lot of those requests will reverse once values reach a point where people say, actually, I think they're going back up. I don't want my money at this bottom, if you will. I'm going to stay in and recover.
Right. That's what so someone, the units are notionally at like $100, and then someone says, well, to actually redeem the units, it'll have to be $90 because of liquidity constraints. They say, well, no, I don't want 90. And then they're in, and then the value comes back up to 100. They say, no, I'm actually fine now. So, but that's a relevant consideration for the investor, right? Because the question is, like, if the true ability to redeem is less than on demand, and so if you're fine with that, like, this is offering a great risk return profile. But if you're not fine with that, maybe you want to be in the public REITs, but that will be the more volatile asset class.
Yeah, or maybe you want to be in both, right? I mean, we're a big believer in it being a both decision, a diversified decision, not an or, in that I don't think any one of us or any, client, wealth management client on average needs to liquidate their entire portfolio every day of the year, right? If you need more liquidity, you should probably be more in public markets, but then you're going to have more volatility. If you're saving for retirement, I think of it more like a 401k. I'm okay whether it's public or private. These values I'm somewhat okay with, because I don't need the money today. I don't want it at the bottom, certainly. And I think public markets actually tend to allow that to happen more than it should, right? If you think about the kind of studies out there, people tend to panic and take their money at the least opportune time. Private markets almost by definition limit that to a degree. But if you wanted your money heading into the financial crisis, if you wanted all your money back in 2007, you could have got it, out of this index. It was complete liquidity. You just couldn't get it at the complete bottom, which actually in hindsight is probably the point you don't want it. Going in again to this cycle, last year, anyone could have got all their money out, right? I think in some of these non-traded REITs, and now it's going to get a little more challenging, but I would argue, you should work through the cycle because it will be okay on the other side if they're quality assets. Does that answer your question, Jason? Is that a fair?
Absolutely.
Here's another way, and again, to kind of think about this a little more clearly in the context of an asset allocation portfolio. We kind of think of the world a little bit in private real estate as kind of pre-COVID and today. So, this is a purposeful time period of thinking, fourth quarter 2019, really before we even heard of COVID or knew what it was. You can see how the public markets reacted, meaning the S&P and REITs, and certainly bonds, really kind of rallied as interest rates were lowered, right? Kind of fast forward through that, and you can see, interestingly enough, while private real estate might take longer to, rationalize lower values, I would say the same is true as values rise, right? It doesn't rise as fast. It takes time for the values to filter through the system a bit. So you don't get the, instant kind of value pop you might in the public markets either, smoother ride all the way around. And so you can kind of see where we are today. I think, the big REIT discussion was REITs were down 25% last year. Whereas private real estate, and you can see, interestingly enough, they never peaked quite as high as private, really close though. And then they fall and they're kind of coming back up. I think, in reality, in the short term, could private come a little closer to REITs, and could REITs come up a little closer to private? Yeah, probably. But the trend certainly tells you over time they smooth out. I think the real challenge in today's environment, and what's really putting a little pressure on liquidity in the institutional markets, is that bond number. Last year was the first time in a very, very long time we've saw equities and bonds decline, right, in a portfolio. And that put a lot of asset allocations out of whack, meaning private real estate values went up, private equity overall values went up, and all the public market values went down. So if you wanted a 10% allocation of private real estate, you in essence ended up with a 15% allocation of private real estate last year. And that's a bit of what's sucking some, I would argue, liquidity out of the market in the private, sector. But what is also probably a pretty good buying opportunity if you do have liquidity. I think, as we talk to clients and institutions, if they have liquidity, they've started buying again. They're pretty bullish on the sector overall. Here, just to kind of, Jason, I think put a nail in it. I mentioned the drawdowns, and just to kind of show, again, over a much longer period of time, private real estate drawdowns are pretty limited. And Brian will talk about this in these sectors specifically in the next page, but in peak to trough. But you can see public markets are not a great foreshadow of what's going to happen to private, but when there are drawdowns in the private markets, they tend to get offset as the public markets recover. So Brian, maybe talk a little bit about kind of peak to trough, returns and what it's meant over the last few cycles.
Thanks. So what we're looking at here is stock, REITs, and Odyssey, and bond and Odyssey performance over those last three cycles. So in the 1990s, the SNL, the tech bubble, and then the GFC. And what you're going to see in that average with the box around it, the average downturn, peak to trough decline for those asset classes, you can see high 30s for stocks and REITs. Odyssey was about 16% or so, and then bonds, really did what they were supposed to do and not go down that much. Interesting with COVID too, we saw such steep declines in the public markets on the right-hand side of the page for stocks and REITs, where real estate and bonds kind of did what they were supposed to do. 1 quarter later, slight revaluation, and then a really, really strong 2021. So over time, Odyssey just reacts less to what's going on and the kind of the fears and the panic in the broader market.
So, I think we covered cycles kind of ad nauseum. We thought maybe we spent a little time on the fundamentals, right? What's driving the income? What's it mean going forward in terms of inflation, in terms of this potential talk of a recession that we're not seeing so far, or maybe some are. But, from a high level, our view is real estate is driven by NOI, net operating income. And that net operating income is driven by companies and people paying rent to be in a building, and that owner being able to have a return on their investment. So this is NOI growth. And remember, this is percentage change year over year. So as we look at it, you can see there is certainly an impact in the net operating income and an actual, received income with COVID. First quarter was the bottom when the world and especially the US shut down. But you can see how quickly that NOI came back and really reacted to inflationary pressures. So landlords have really been able to grow their income and grow their rents on a year-over-year basis in response to the inflationary pressures we saw. I think also don't overlook how these NOIs are consistently been positive. Going back really to the 2012 coming out of the financial crisis. This is compounded growth rates over time, that ends up being an enormous impact on your total return. So year over year, kind of steady Eddie growing those NOIs creates higher cash flows and higher values ultimately over time. And so, Brian, maybe touch on then, we mentioned early on occupancy, but maybe touch on where we are today as well.
Yeah, I think this will surprise people. Again, going back to what you read on the news and the paper and how everything's bad, but if you have a big diversified portfolio of high quality assets, and in real estate, we have not been oversupplied for the past 30 years. Occupancy is really, really sticky within core real estate funds. So what we're showing here is the peak to trough decline in occupancy in the 90s, the tech bubble, and the GFC. You can see, during COVID, just a very slight decline. Right now, we're back near COVID peak. So, there's just really not a whole lot of stress on occupancy, although what you read in the paper might say, hey, office is doing really bad. Oh, my real estate must be doing really bad. Well, industrial's at 98% occupied. Apartments are at, 96. Retail, shockingly enough to those on the call, is 95%. So things are doing extremely well in other parts of the portfolio. But overall, we're at 93% occupancy, which is historically near its peak.
So these price adjustments, or outlook are really a function of the capital markets, right? What do I price my future return being with interest rates where they are today, et cetera? So, this last slide, is not meant to really kind of look at a historical cycle. It's more to look at how are the financial markets impacted performance. So cap rates, think of an inverse to a bond yield. Through those previous cycles, Brian mentioned in terms of how the financial markets reacted, in the S&L crisis or RTC days of the late 90s, early 90s, 2000s, you can see cap rates really went up because the outlook to be able to rent those buildings and grow NOIs was limited. So people wanted a higher going in yield. From there, the markets and the cap rates really adjusted down, kind of consistent with lowering interest rates until we hit the great financial crisis in 08, 09. You can see it was pretty steep. but really short. Returns coming out of that cycle were really strong, which we'll touch on in a minute. And now kind of coming back to current times, you can see, cap rates have adjusted by about 25 basis points again. I think really in reaction to the Fed and kind of where rates are going. So, I think we're getting a bit close on time. Maybe Brian, I think the last thing we wanted to leave it with, like all sectors or like all investing, timing the market can be, really challenging and frankly, really, difficult and costly to clients. So I think if we leave anything, the most important thing is to be a consistent asset allocator. Stay within your allocations and work through cycles, whether that be public or private markets. This shows you basically, if you try to come in and out of these cycles, your multiple on return can be hugely different by just 1, 2, or 3 quarters time difference. So again, it really doesn't pay to try to time these markets, whether it's private or public. And then coming out the other side, the start of the new cycle, again, is pretty attractive. When we look at total returns over a cycle being closer to 8, coming out of these downturns can be a really good buying opportunity, though, if you do have cash and you are under allocated to private markets. So with that, maybe I'll pause there. Any final questions? We only have a couple minutes left, if any.
I think we're all done, lads. That was very informative. Thank you very much. I've learned a lot. Everyone, sign up for the annual meeting, the golf outing, and our other events. Thank you to our sponsors, and we will see you all again.
Thanks for having us. We enjoyed it. Thanks very much.
Thanks,
Thanks, folks. See ya.
Thanks, Jason.